The market is bleeding, and one of the things that everybody is asking is, where are the institutions? Are they ready to jump in and wade into the waters of crypto? We'll break it all down for you. Let's do one thing, and I do want to thank our sponsor, and that, of course, is iTrust Capital. You guys can get into a crypto IRA very easily by just joining iTrust Capital. One of the ways that you can do that, of course, is by using our link. Now, you can get into all sorts of digital assets, gold and silver. They are one of the most flexible platforms out there in terms of building a crypto IRA. So use our link. It gives you a $100 funding reward just to get started. You guys can jump in there. It's going to be a good one today because we've got a special guest that'll be joining us here in a minute. Before I bring him on, I want to play a clip for you by Mr. Novagratz. This is an interesting take. Take a look.
Oh, the pain, the pain, the pain. I think what happened was post 100, people started selling and it became a little bit of a virus. Remember, Bitcoin like I used to call it a religion. The commandments of the religion was HODL. Hold on for dear life. Now we got 2 legs, 1.5 legs left of narrative. It's, will market structure pass? And does that give us a little bit of juice? Listen, the one thing I would say about crypto, when everyone declares it dead, there's lots of opportunity.
All right, so there you've heard it, lots of opportunity. We may be nearing that event in terms of where the market is right now. So I wanted to bring in an expert, not only in the market, but on institutional capital, where that direction is going. Joining me is John D'Agostino, who is the head of strategy with Coinbase Institutional. How are you, John?
I'm good, Paul. I'm not going to sing. Are we okay with that?
That's good. I think you've got Mooch and Mike on there really trying to sing in the blues, more likely, of where the market is right now. When you look at what's happening within the market, you have to kind of consider this right here. And this is the insane drop that we're continuing to see. Remember, on October 6th, we saw a $4.3 trillion market compared to where we are right now, $2 trillion in 4 months. This is, as many would say, a bloodbath out there. Let me ask you this question. Is Trump good for crypto or bad for crypto? I'm beginning to question this.
So let me start by just addressing those insane numbers, because in a way, the magnitude of those drops on a dollar basis is a function of how successful the asset class has been. And it sounds like hopium. It sounds like, just verbiage, but that's the reality, right? So this is an asset that probably in my lifetime will continue to exhibit significant volatility. And that's not because it's idiosyncratic or quirky. I mean, crude oil, the world's most valuable commodity, exhibits similar volatility. And I keep reminding people it went negative less than a couple of years ago. So this just may be an asset that's how it trades forever, for lots of different reasons. And as it becomes more successful as an asset class, that notional market cap value is going to keep getting bigger and bigger and bigger. And so when it drops 20, 30, 40%, which is going to be prone to do every now and then, on an absolute basis, that number is just going to get gigantic and unfathomable. And people have to understand that you have to think of it on a percentage basis, not on a notional value basis, or you'll continue to get shocked over and over again.
Well, I think the point you're hitting on is that the volatility is real, but that almost lends itself to the departure from store of value, which is one of the narratives that has been looked at for quite a while, especially on Bitcoin. We're talking about Bitcoin here. Bitcoin crashes below 67K. This is erasing all gains since the Trump election. So would a brand new investor or institutional capital say, well, with this kind of volatility, this is no longer a store of value. This is a speculative asset.
Well, Paul, I am very sympathetic to that view because I'm a classically trained finance person as well. A very, very dear friend of mine, Nouriel Roubini, who I respect a lot, who I disagree with but respect, just kind of is doing a victory lap recently and making that same argument. And I get it. I understand why people think that way. There's an alternative view, though, that I think is depending on your duration, which is if we know for a fact that inflation is beating the long-term accretion rates of assets we historically viewed as stores of value. If we know that for a fact, which I think we do, any reasonable comparison of long-term gold trends, long-term real estate trends versus expected inflation, you just don't make your money back over time. You just don't beat inflation. If you believe that, as I do, then including inclusion of an idiosyncratic asset that tends to have more upside volatility than downside volatility. And even with this drawdown, if you look over the last 10 years, it has more upside vol than downside vol. If you don't, the argument I would make is if you do not include an asset like Bitcoin into your weighted pool store of value play, with the goal of which is to beat inflation, that's the goal, then you fail. You just fail using traditional assets. So I think it's Bitcoin. I don't think it's just Bitcoin. But my counter argument to people who will kind of gloat during these times is pull back 10 to 15 years. If you go back in a time machine and you could say create a pool of assets to hedge against inflation over the next 15 years, if you don't tell me you're including Bitcoin, you're lying to me. You're just flat out lying. So I get it. But I think, again, you have to think longer term, and you have to think what the actual goal of a store of value is.
Well, I would say this, that, since the fall from around 80K, I have had more people calling me that have been in, my generation, Gen X, and boomers, asking me, hey, Paul, do we think we'll see a sub 60? So it's basically the sharks circling. These are guys with high net worth. They're looking for a potential opportunity like what you're talking about, which is more long-term vision. And I think this tweet kind of nailed it right here. If the boomers don't save us at 75, we're cooked. But the point is that you got Eric coming in and saying, wait, don't worry about it. We're setting on 40% down plus in October, but yet at the same time, ETFs are down only 6%. So that tells me that maybe long-term investors are looking at this differently than what we have seen true crypto investors looking at that. And that's what I think what you're saying is that this is a different kind of horizon.
Paul, I think that's a sober way to think about it. So I don't, in these situations, I think folks in crypto should just acknowledge things are bad, right? So one of the reactions I don't like in crypto is everything's good for Bitcoin, everything's good for crypto.
Right.
If you point out these things, you're FUD or you're weak hands. That's not true. These are very, very trying times. I would say that to anyone who was holding gold in early 2008 when it was down 30% off the highs. I'd say it to people holding other challenging volatile asset classes. So that's the first step, is things are bad. But there are indications that we're not seeing a capitulation along the lines of what some of those who are sort of embarrassed that they've been wrong about Bitcoin for 10 years are hoping for, so they can finally be proven right at the dinner table. One of those is what you mentioned. And people think of ETFs as institutional. In some ways they are, but in most ways they're not. They're retail driven. So there's a retail component that has done the homework over time that's holding. If you look at the open interest and volumes in the futures and derivative side, it's not falling off a cliff the way we would expect if a market was just selling out and people were leaving. So that's hopeful. Polymarket today has over a 60% chance, and Kalshi have over a 60% chance of a market structure being passed by end of year. So, I step back and say, what is fundamentally different today than, say, 120 days ago or 110 days ago when Bitcoin was at all-time highs? There's probably a different outlook on the political side. That's one change. October 10th shook people to some serious degree. But what we didn't see from October 10th is we haven't seen a major liquidity event. We haven't seen a major dissolution like an FTX or some major fraud uncovered. Those are all positive things that indicate we're not looking at capitulation, we're looking at typical volatility.
Yeah, well, I would say for October 10th, maybe not yet. It's possibly that this is maybe still brewing, in the market, because many people are looking at where this market is going. Here's the absolute bloodbath lineup here. Gold dumping 5.5. That's 1.9 trillion, by the way. Yeah. Silver at 19%, 980 billion. S&P is down, NASDAQ down, Russell 2000 down, Bitcoin dumping 8. This looks like a baker's dozen of not the place to be when it comes to investing. So with all of that unwinding as we go, I guess the real question is, are all of these sell-offs connected, do you think? Or are these independent?
To some degree, I would say yes, because let's be, and this again, it's a symptom of the success of the asset class. As we both know, Paul, I've watched your show. You're very astute. There's 5 to 10 prop shops and market makers in Chicago that control a significant amount of order flow of all risk assets in the US. And when you become an institutionally investable asset class like crypto has, you gain their attention and you gain their flow. And the reality is that when the world goes risk off, those 5 to 10 prop shops go risk off, and that drives a lot of the activity we see in capital markets. So if you want to be a player, if you want to be an institutional asset class, you become subject somewhat to those whims. The good news is, and we looked at this a lot, because when I was head of strategy at NYMEX, everyone was really upset that hedge funds and prop shops and market makers were directionally pushing the price of energy commodities in one direction or another. And we took a really close look at this. And here's the reality. These groups definitely exacerbate trends, but they do it equally on the upside and the downside. And over the longer term, they don't really control price direction. So there's no question that crypto now being institutional and in that pool of market makers is exacerbating the trends, but it's also going to do so on the upside.
One other thing that I want to kind of get to is the impact that we've seen now with the Trump administration that I would say is starting to unravel a little bit. And one of the things was, of course, the House lawmakers launched this probe into WLFI. And this is a big deal because it does, now granted, I know, listen, there's a lot of inside deals being done on traditional finance. There's inside deals being done, you know, when it comes to risk assets. But in general, do you feel like this is going to be kind of a cast around crypto, that this is happening and it's so closely related to the Trump administration?
I mean, I think, again, not a policy expert. I think it certainly is going to be used as a weapon. There's no question. It's going to be in the narrative, and then those in the industry have to figure out a way to answer that. Like my view on this is simple. Again, not a policy expert, not responsible for Coinbase's policy position, but just somebody stepping back and with a lot of friends who are on the left and the right side of modern politics. It doesn't seem clear to me. We had the Disclosure Act passed a number of years ago, but it doesn't seem clear to me that we as a society have decided how we want our government officials to engage in capital markets. I don't care whether it's commodities, equities, crypto, whatever, right? You've got some people in the aisle accusing other people of manipulating equity markets. You have some people accusing of manipulating crypto markets. So what I would say is that what seems unfair is signaling out any one market. That seems unfair. That seems punitive and arbitrary and capricious. So the notion that we should figure out how we want our government officials to interact with capital markets overall, set a fair level set fair rules, and have everyone apply to those rules, that seems reasonable. What seems disingenuous at this moment is using crypto specifically as a cudgel, when a couple of years ago we were having the same discussion, but it wasn't about crypto, it was about equities. So that would be my view. I think that seems to be the most fair view, is don't use this as a cudgel in a sort of really unfair attempt to win an argument right now that your lobbying groups have pitched you to win. Let's solve that problem overall, but let's have everyday investors gain the benefit of higher rewards and interest rates when they can get it, versus earning 10 basis points in their checking account.
Do you think that, because this unwrapping of what's going on in WLFI could open up a lot more can of worms? I mean, we could end up like almost an Epstein level event in crypto, where we're starting to see all these little things
let's not
tie
connect.
in.
Let's not connect. Yeah, let's not connect them on. Come on, man, Paul, I love you, but let's look. It's going to be used as a weapon. There's no question. And depending on how the elections go, there'll be investigations, and I'm sure that I don't think as an industry we should allow the narrative to be hijacked through via personal vendetta. So again, I go back to this. Everyone should follow the same set of rules for every asset class. I'm just not aware that those rules exist. And if we're going to make them, let's not make them targeting one specific asset class. That seems disingenuous, and that also seems inefficient.
Well, I guess the question really remains then, if that is the fact, if you got the Democrats kind of camping on this issue with policy around the Trump administration, but at the same time, senators on both sides of the aisle are out there trading stocks very efficiently, apparently. So we've seen that for quite some time. Do you think we're at a point where institutions are trying to figure out, is this something I want to be involved in? I mean, obviously they're involved in the equity side and this is going on. So are they simply saying, no problem, we see this as a future, we're still all in? Where do they stand right now?
So I don't know of a single, what I would call institutional level investor that has done the work on this asset class, has made the decision to go into it, who is scared off by lack of regulatory clarity. We want the Clarity Act to pass, of course, but there are lots of kind of niche-y, massive industries that exist without perfect regulatory. In fact, I don't know an industry that has perfect regulatory clarity. There are opaque areas of every rule that comes out of Washington. So I don't think it's that. I do think the drama causes people to maybe put a hold on their plans for a little bit of time. They don't. Nobody wants to have the asset class they're investing in be the subject of vitriol and attacks in the newspapers every day. But that's very, very temporary. So no, I don't know of anyone who's done the work who has said, we like the asset class and now we don't because we may not have this new rule. Again, I think we'll have it, but that isn't required for institutions to dive in. They've done the work in an environment without that market structure bill. So if they got comfortable making that decision, then they'll be comfortable regardless of where we wind up.
Yeah, well, clearly regulation, the path that we've seen, even if you just look at the CFTC and Polymarket, that has kind of put Polymarket in a very good position, I think, in general, when you look at what's going to go on with prediction markets. So regulation is very important, in going forward here. Probably the critical point that could resurrect this market off of the floor. Would you agree?
Okay. But look, Polymarket and Kalshi, fantastic companies. Polymarket and Kalshi are both still, being sued in several states. It's not exactly clear where prediction markets will wind up, but it's an exciting technology. It's a great technology. It's a great product, so it's growing. So my point being, you don't need perfect regulatory clarity to have institutions pile in. So but to your point, but I want to be fair, Paul. You're absolutely right. Of course, without question, passage of a fair market structure clarity bill will absolutely go a long way. I'd say I hate contingent causality. So I don't think that's going to be the thing that if we need one thing to save us as an asset class, that's problematic. What will save us as an asset class is the technology is superior. The clarity bill passing, a fair version of it at least, will absolutely accelerate the bottoming out and the recovery. There's no question.
All right, one thing that happened yesterday was that there was a little pushback here. Crypto industry proposed an expanded community bank involvement in stablecoins. So do you know about what happened, in DC, where they kind of flipped this across to the lobby with the banks, and then all of a sudden we get a slowdown? Why do you think that occurred?
Politics, not to sound cute. I mean, look at there's another issue I'm very familiar with because it goes back to my history. So the argument over exemptive relief, SEC exemptive relief, and people might say, well, hold on, wait a second, why is that a big deal? Why do you care crypto if you can't be given? So exemptive relief, for those viewers who aren't policy wonks, is just kind of a fancy way of saying the SEC looks at a technology or a product or some innovation, and they say, hey, this looks really cool. We think this might be good for consumers in the U.S. Investors. However, we don't really have rules that kind of govern it. So we're going to let you do this in a kind of small way, and we're going to watch it, and we're going to make sure no one gets hurt. And if we like what we see, we're going to let you do it more. And while you're doing that, we're going to create the rule set. That's basically what exemptive relief is. And so a cynical view is, well, why does crypto want it? Because the other side is saying crypto can't have it. Everyone else can have it, but crypto can't have it.
Right.
The reality is, if you look back at a wonderful innovation called exchange traded funds, ETFs. When ETFs came around, they were allowed 300 exemptive reliefs over the first couple of years of existing, and that's largely why the U.S. is the largest ETF market. And so we have things that we take for granted in capital markets that make us who we are, make the United States the most liquid and enviable capital markets in the world because of exemptive relief. Because a smart SEC is willing to admit, hey, innovation moves faster than rules. There's no way. I mean, I think the SEC is full of great people. I genuinely do. I've been working with them for a very long time. I think they do what they think is best for the country. It is impossible for them to keep up with innovation and technology. And so smart SEC staffs in the past, administrations have said, we get this. So we're going to corral it, make sure it doesn't hurt anyone, but we're not going to stifle it. If you take away that ability, number one, you're saying we don't trust the SEC to decide what's best for the investor. That's literally what they're there for. And the second thing you're doing is signaling out an asset class and putting your foot on its neck. And the net result of that, as we saw in the prior administration, is all of that innovation moves offshore.
Sure, sure. Well, that's the fear I have still with where we are right now, because I'm still skeptical as to whether or not we can get through this through DC. Speaking of that, when you look at the politics being played, we're also seeing politics being played in the finance markets. Cathie Wood went on talking about what Binance was doing and their involvement possibly in 1010. CZ responded to that, and I wanted to get your opinion on this, if you'll take a look at this clip.
Sure.
The highest complaint I've seen so far is on the October 10th crash. Some people say Binance caused it. It's pretty clear that the tariff announcements preceded the crash, not Binance system issues. Understand that Bitcoin itself is a $2 trillion market. They would probably have to risk in the order of hundreds of billions of dollars to try to impact the Bitcoin price. For any single entity or individual to do that, they have to take that risk that they may lose a couple $100 billion. I would never want to do that. If any of you guys still think that, anybody who still think Binance deliberately caused that crash or try to sell Bitcoins to manipulate the price, that's just really, really far-fetched. In this world, no technology is guaranteed to work all the time. The internet can be broken. If you bet on all those things working all the time, if any time those things have any weakness, you're going to lose all your money, then you're probably risking too much.
All right, so that was CZ, obviously the former CEO, I guess, of Binance. Do you think that the DOJ would possibly look at Binance again for an investigation based on anything coming out of that 1010
Sure.
event?
It would have to be really hard evidence. So look, I don't know what Cathie said. I'm a big Cathie fan. I think she's a brilliant person. I'll just go back to my history at the NYMEX. So every time the price of crude oil and natural gas would spike or volumes would accelerate, we would have functional issues. And this was an exchange that was 99.99999% uptime and with a fantastic CIO. CZ's right. Whether it's pre-internet or post-internet, volume floods systems. And it doesn't matter how well you set those parameters. When you reach unprecedented level of volume activity, everything breaks down. Human systems break down, technology systems break down. So I haven't seen evidence of malfeasance on behalf of any exchange. I'm sympathetic as an exchange executive for 20 years that to his argument that sometimes things break. And Binance being as big as they are, of course, they're going to be in the center of that activity. I know people who work at Binance. I don't believe they're interested in manipulating at large scale this market. So I would, Cathie's a smart woman. So I would say if there's evidence, then yes, the DOJ would open an investigation into any entity that was potentially causal. But I haven't seen anything to indicate that.
John, when we saw the Ondo Summit this week, we saw something that kind of showed up that I thought was interesting, and I'll show you some of these, the institutional era, as they're calling it right there. You recognize a lot of these guys, but the point being is that we're not seeing the kind of the status quo of crypto. We'll call it the top 10 tokens out there. When you look at the market as it is now, because many of these are going to end up really creating their own blockchains, all sorts. If you look at the rise of Canton, there's all sorts of potentials here as we move forward. Could we see a cycle here where the old crypto, which is kind of the current crypto, becomes maybe no longer relevant in comparison to the growth, much like in the era of the internet, where we had companies pre-internet, and then what came out of that was a completely different set of companies. Do you think that's possible this time around for blockchain?
That's a great option. First of all, I love this format, by the way. I love responding to tweets. I feel like I'm sitting next to my wife, like sharing memes. This is great.
That's good.
It's a lot of fun. It's a lot of fun. So look, I actually do. You just framed it very succinctly and eloquently. I want to just be clear. So a lot of people in crypto Twitter, especially the OGs, the crypto natives, they sort of bemoan what they view as the co-opting, right? They would look at that list of names and say, what a shame that we don't have brand new names. What a shame that they haven't been disintermediated, et cetera, et cetera. I don't necessarily want to see current financial infrastructure burned to the ground. I want to see it replaced and evolved slowly and smartly over time. Because when you burn things to the ground, when you burn existing infrastructure to the ground, you hurt a lot of people. So I'm not interested in revolution in that way. Crypto goes through bubbly periods. There's no question. Gold goes through bubbly periods. Commodities go through bubbly periods. Bubbles have a bad reputation. But there is one thing that they do well. They inspire a lot of investment, and they inspire a lot of research, discovery, and innovation. Now, a lot of that research, discovery, and innovation winds up being worth nothing. But some of it is worth massive amounts. And so you can't, and I'll argue, I'll go on a limb here, Paul, and say, I'll argue that it's hard to really innovate without something that resembles a bubble in some way. It's difficult. I don't know if we would have PayPal, Google. I don't know if we'd have that financial infrastructure if you didn't have that early internet bubble. You need massive amounts of capital and innovation. And the great thing is the result of that is what I call productive versus inert bubbles. Inert bubbles are like, real estate bubbles in the middle of nowhere, and everything blows up and there's no roads, there's no plumbing, there's nothing. It's just a ghost town, right? That's an inert bubble. It didn't produce anything of value. Productive bubbles produce infrastructure that you build on for the next layer. There's no question, if you just stop and look at where we are right now with blockchain and crypto versus say 5 years ago. We might have gone through periodic bubbly asset price periods, but every time we're left with more resilient, ingrained financial infrastructure. Larry Fink was not saying everything will be tokenized 5 years ago. He's saying it now.
Yeah. Well, and I think that is to the point is that if you just look at what happened at WEF, it was a complete flipping of the script in terms of where blockchain was just 2 years ago, much less what we're seeing now. It was almost unheard of to even see a blockchain executive on a stage 2 years ago, and now we're seeing on the main panels. So it's kind of interesting.
And every major exchange has basically announced the beginning of testing of either side-by-side or adjacent blockchain-based trading. And if you think that we're both Gen X, if my Gen Alpha daughter, if you genuinely believe that when she's our age, she won't be using blockchain rails to transfer value, we have an argument about that. Just like saying she won't be using driverless cars at my age. Of course she will.
I've got 6 digital asset themes coming over from Wintermute right here. Everything becomes tradable. Stablecoins become the trust. Markets will reward durable revenue, so temporary incentives. DeFi converging with fintech. Privacy becomes table stakes, and then regulation matures into a distribution edge. You like any of those, or do you like them all?
Well, I mean, I'm not a fool enough to argue with Evgeny. He's one of the fiercest brains, and I use the word fierce on purpose. He's an intimidating guy. Okay, let's go through one by one real quick. Everything becomes tradable. Couldn't agree more. Now that doesn't mean everything becomes liquid. I think he's very, very smart with his words there. Blockchain doesn't magically solve liquidity problems. What blockchain does is make liquidity better and make value transfer better. So just if you have a bad product and you put it on a blockchain, it's still a bad product. So that's clear. But everything does become potentially tradable. He's exactly right. Stable coins become the trust layer. Could not agree more. Biggest growth story in crypto right now. That's why we're so bullish on USDC. Markets will reward durable revenue, temporary incentives. That's obvious. I think that's a throwaway. I think he's right there, of course. DeFi will converge with fintech 100%. Institutional, what I've been shocked about is I work with these very, very large institutions, pensions, sovereign wealth funds, et cetera. They're very, very smart, but they're very, very slow. And they do the work, and then they call me and say, we want to start doing some stuff in crypto. And I think, great, you want to buy hold some spot Bitcoin. No. We're going to do a swaption on Hyperlink. I mean, they get complicated very, very fast. So I think he's right there. Privacy becomes table stakes. Agree and disagree with him. I think that privacy will absolutely become increasingly important. I do think that that's the one area that has the most conflict with government. And I think that's the one that's going to have the most friction associated with government. So while I think it becomes more important, I think it becomes harder and harder to actualize. Regulation matures into distribution edge. I think Coinbase proved that with the Monad distribution. We distributed $270 million roughly without the use of any underwriter or investment bank in a regulatory compliant way. And I do think that's the future of capital markets distribution. So I'm 5 for 6 on Evgeny. Do not tell him I disagreed with that. 6th one, I don't want to get yelled at.
He's probably watching the show, so hopefully.
He's a very, very, very smart guy.
We have him on. We have that team on occasionally. I've got a line list of questions here, kind of our rapid round that we fire at guests. First one is this one. It's a big one. Should someone get fired if clarity doesn't pass? I'm like, somebody, come on. This has got to go through.
If I don't have to say who, then yes.
Okay.
And anytime there's a big failure, leadership should step down. I'm not saying who, but yes.
All right, I got you.
Maybe it's me, Paul. Maybe who knows?
I don't think so. I know who it's going to be. Coinbase compromises on stablecoin yield. Don't do it.
No.
All right, you're going to fight to the end.
Sorry, no. It's got to be. It's got to be right. It's got to be fair. It's got to be good for the consumer.
All right. Let's look at this one. Institutional chains are a hype scam if they don't connect to ETH and Sol. What do you think?
I'm going to say no, just because I want to have the luxury of another couple of chains. But I'll change. If you say institutional chains are a hype scam if they don't connect to the top quality dozen or 5 to 10 chains, I would say yes. But I'm going to say no to just ETH or Sol. I'm big believers in both, but I'm going to just too tight a question for me.
Do you think crypto custody providers are going to unite with banks at some point for self-custody?
Well, I think banks are going to work with companies like Coinbase because they're going to realize that it's better to white label our tech than build it themselves. Yeah. But not to limit self-custody. I would say not to limit it. There's no attempt to limit self-custody. That is an inalienable right and wonderful option. Okay. I don't think most people will avail themselves of it. I think most people will choose a custodial response. So I'll say crypto providers will unite with banks, but to provide more options for more custodial options.
Not limitations. All right.
Not limited. No who's more
your right to who's more responsible here? We got a crypto winter coming in. I know I'm picking.
No. Paul, you went out. I'm sorry. I can't see you.
You can't hear me?
Kidding. No.
Yeah.
How about this question, Paul? Does John like his job and remaining a citizen?
Okay, all right, we'll pass on that one.
Let's ask that question.
Do you think Trump will make a public statement defending stablecoin yields?
Ooh, that's a good question. I hope he makes one alluding to it, maybe not direct.
I think he will.
I'm going to say yes too. Yeah, I'm going to say yes. Maybe not directly, but I think it's a general statement of like he's for the people, so the people should be allowed to get their interests. Well, so I can see that.
And man, affordability is at such a peak interest right now with that administration. This, of course, addresses a lot of that right now. What about IPOs? We saw BitGet which one was it BitGo came out. Yeah, we saw BitGo come out. Do you think we're going to see other IPOs that don't perform well this year?
Well, again. So the answer to your question is yes. The answer to this question is no, because I don't think every new one will fail.
All right.
So I think we'll see some new ones fail, but not every single one.
Some are going to win. I like it. All right.
Yeah, because some are really good companies with cash flow.
Here's the big one. 2026 crypto market cap fully recovers. 2026 by end of year. What do you think?
2026. Yes.
Oh wow. Okay.
Yeah, I do.
You go, John. You're all in. I like it. I
do. It's a coiled spring. Sortino focus on Sortino, not Sharp. That's what the asset class has delivered historically.
Okay.
I think we'll have clarity one way or another. Pardon the pun. And I'm actually fairly bullish. If you would have told me Q1, Q2, I would have said no. End of year, I'm fairly bullish.
All right. I like it. John D'Agostino coming in from Coinbase. Thank you so much for coming in today. We appreciate it.
That was fun, Paul. Thanks a lot.
If you like this video, hit like and subscribe, drop a comment down below, and also join our free private member group. The link is in the description.